It happens in complete silence. No letter arrives, no government agency calls, no attorney shows up at the front door, no warning appears on your tax return. One day, a married couple has access to a tax protection worth $500,000. The next day, one spouse passes away. And without a single vote in Congress, without a single change to the law, that protection can be cut in half. Just like that. $250,000 disappears. Most retirees have never heard of it. Most surviving spouses discover it only after the damage has already been done. And by then, the clock is running. Because the government actually gives surviving spouses a small window to protect themselves from this tax hit. Miss that window, and the opportunity is gone forever. Today, I'm going to show you exactly how the so-called widow tax works, why it catches so many families by surprise, and the simple deadline that can mean the difference between paying $0 in capital gains taxes and writing a check for tens of thousands. Stay with me until the end, because the final story involves a retired school teacher who unknowingly missed the deadline by just 5 months. That mistake cost her family nearly $87,000. Let me introduce you to Robert and Susan Miller. Robert spent 34 years working for the local utility company. Susan taught second grade. Neither of them ever considered themselves wealthy. They simply stayed in one place. They bought a modest home outside Denver in 1988 for $142,000. Nothing extraordinary. 3 bedrooms, a 2-car garage, a backyard where they raised their children. Over the years, they replaced the roof, updated the kitchen, remodeled the bathrooms, installed new windows. They paid their mortgage every month, never missed a payment, never refinanced to pull money out, never treated the house like an investment. It was simply home. Fast forward to today. That same property is worth approximately $1.2 million. Not because Robert and Susan were financial geniuses, because they stayed put, and because America experienced one of the largest housing appreciation cycles in history. When people hear that number, they usually think the couple won, and in many ways, they did. But hidden inside that success is a tax problem almost nobody talks about. A tax problem that doesn't show up until one spouse dies. In the spring of 2027, Susan passes away unexpectedly. Robert is devastated. Taxes are the last thing on his mind. For nearly a year, he stays in the house alone. The rooms feel larger now, quieter. Every corner reminds him of Susan. The dining room, the garden, the chair she always sat in. Eventually, Robert decides he wants to move closer to his daughter. The house is too large. The maintenance is becoming difficult. He contacts a realtor. The home sells quickly. The final sales price comes in at $1.25 million. Robert assumes everything will be fine. After all, he remembers hearing something years ago about a $500,000 tax exemption on the sale of a primary residence. His CPA mentioned it once. A neighbor mentioned it. Maybe he read about it online. The number stuck in his memory, $500,000. What Robert doesn't realize is that number came with conditions. And one of those conditions quietly changed the day Susan died. Here's where the story becomes expensive. Under current federal law, a married couple can exclude up to $500,000 of profit when selling their primary residence, provided they meet ownership and residency requirements. For a married couple, that's an enormous benefit. But after a spouse dies, the rules change. A surviving spouse eventually becomes a single filer. And single filers generally receive only a $250,000 exclusion, not $500,000. Half. Think about what that means. The same house, the same appreciation, the same family, the same lifetime of ownership, but one spouse is gone, and suddenly $250,000 of tax protection disappears. No new law, no legislative change, just a status change in the tax code. Married, then widowed. And with that transition comes one of the most misunderstood tax consequences in retirement, what most people call the widow tax. Now, before you panic, there is something critically important you need to understand, because the story doesn't end there. In fact, the next part is where the opportunity appears. The government actually provides surviving spouses with a special 2-year window, a very specific window, a very valuable window. And if you know it exists, it can completely change the outcome. The problem is that most families are never told about it, which is exactly why so many retirees lose money they never needed to lose in the first place. Let's walk through exactly how that window works, because this is where the difference between paying nothing and paying tens of thousands of dollars starts. And I want to make this as simple as possible. Imagine Robert's situation. He and Susan purchased their home for $142,000. Over the years, they invested another $108,000 into major improvements. The new roof, the kitchen renovation, the windows, the bathrooms. That means their adjusted tax basis is approximately $250,000. Now remember what happened when Robert sold the property. The sales price was $1.25 million. On paper, that's roughly $1 million of gain, a life-changing amount of appreciation, and exactly the kind of gain that can trigger a very large tax bill. But federal law provides an important protection. It's found in Section 121 of the Internal Revenue Code. If a married couple meets the ownership and occupancy requirements, they can exclude up to $500,000 of gain from taxation when selling their primary residence. That's the rule most people have heard about. The problem is that most people stop there. They never learn what happens after a spouse dies. Because the law contains another provision, one that receives far less attention. If a surviving spouse sells the home within 2 years of the deceased spouse's death, the surviving spouse may still qualify for the full $500,000 exclusion, not $250,000. The full $500,000. Think about that for a moment. Congress essentially created a temporary bridge, a grace period, a recognition that people dealing with the death of a spouse should not immediately lose the same tax protection they had while married. But that bridge does not stay open forever. The clock starts on the date of death, and 2 years later, it closes. Not gradually, not partially, completely. Miss the deadline and the exclusion drops from $500,000 to $250,000 overnight. Now, here's where many retirees make a dangerous assumption. They think if I miss the deadline, I'm automatically doomed. Not necessarily, because another rule may come to the rescue. And this rule is one of the most powerful wealth preservation tools in the entire tax code. It's called the step-up in basis. The name sounds complicated. The concept is not. Let's say your house is worth $1.2 million on the day your spouse dies. Under federal tax law, part or all of the property's tax basis may be adjusted upward to reflect its fair market value at the date of death. In plain English, the IRS may pretend you purchased part of the property at today's value instead of decades ago. That adjustment can dramatically reduce taxable gains, sometimes by hundreds of thousands of dollars, sometimes more. And yet most retirees have never heard the phrase step up in basis until they're sitting across from an accountant after a death in the family, which is unfortunate because understanding it earlier changes everything. Let's go back to Robert. Suppose Susan's death occurred when the home was worth $1.2 million. Depending on how title was held and what state they lived in, part of the property receives a step up. That means Robert's taxable gain may be significantly smaller than he expected. Instead of facing taxation on nearly $1 million of appreciation, he may be taxed on a much smaller amount. The exact numbers depend on state law, ownership structure, trust arrangements, and estate planning choices. But here's the key point. The step-up often saves families enormous amounts of money. The people who understand it before a crisis tend to keep more of their wealth. The people who learn about it afterward often discover opportunities they can no longer use. And that brings us to Linda Parker, a retired school teacher from Ohio. At least, that's what we'll call her. Like many stories in this video, the details have been adjusted to protect privacy, but the situation itself is very real. Linda's husband passed away unexpectedly. For nearly 2 years, she stayed in the family home. She wasn't thinking about taxes. She was thinking about grief. She was thinking about doctor's appointments, family, grandchildren, life. Selling the house felt overwhelming. So she waited and waited and waited. Then, 29 months after her husband's death, she finally decided it was time to move. By then, the market had appreciated even further. The home sold quickly. Everything seemed fine until the tax meeting. That was when she learned the 2-year window had already expired, 5 months earlier. 5 months, not 5 years, not a decade, 5 months. The larger exclusion was gone. The return had to be prepared under the rules that applied to a single filer. The result was painful, a significantly larger taxable gain, a substantially higher tax bill. and money that could have remained inside the family instead went elsewhere. What made the situation especially frustrating was this. Nobody had ever explained the deadline to her. She wasn't trying to avoid taxes. She wasn't ignoring professional advice. She simply didn't know the clock existed. And by the time she learned about it, there was nothing left to do. The deadline had already passed. This is why I tell people that tax planning is often less about intelligence and more about timing. Most retirees are perfectly capable of understanding these rules. The challenge is discovering them before they matter, not afterward, because once certain windows close, they stay closed, and the tax code rarely offers do-overs. Now, there is one more layer to this story, a layer that creates dramatically different outcomes depending on where you live. And if you're married, this may be the most valuable 5 minutes you spend all year, because some states provide an advantage that many homeowners in other states never receive, an advantage worth hundreds of thousands of dollars in certain situations. And it all comes down to something called community property. Most married couples have never heard the term, and yet it can be one of the most important wealth preservation concepts in retirement. In most states, when one spouse dies, only the deceased spouse's share of the property receives a step-up in basis. The surviving spouse's share keeps its original basis. That's the standard rule in many parts of the country, but community property states operate differently. In those states, when one spouse dies, both halves of the property generally receive a step-up in basis. Not half, the entire property. Both sides, the whole asset. This is often called a double step-up, and the difference can be enormous. Imagine a couple purchased a home decades ago for $200,000. Today, that same property is worth $1.4 million. In a non-community property state, only part of that appreciation may receive a step-up. In a community property state, the entire property may be reset to current market value. The result? A dramatically smaller taxable gain if the surviving spouse later sells. Sometimes no taxable gain at all. The house appreciated. The family benefited. The tax burden shrinks, not because of a loophole, because that's how the law was written. The states generally recognized as community property states include Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. If you live in one of those states, it's worth discussing your ownership structure with a qualified estate planning professional. You may already have protections that homeowners elsewhere do not. But here's where things become especially interesting. Because in recent years, several states have created structures that allow certain married couples to elect community property treatment through specially designed trusts. These are often called community property trusts. The rules vary, the requirements vary, and they're not appropriate for everyone. But they exist. And for some families, they can create planning opportunities that simply weren't available a generation ago. The important thing is not whether a particular trust is right for you. The important thing is knowing these conversations exist before a crisis occurs. Because once a spouse passes away, many planning opportunities disappear. The best estate planning almost always happens before it's needed. Which brings us to the most important part of today's video. Not the tax code, not the calculations, not the legal terminology, the actions. Because information only matters if it changes what you do next. If you're married, pull out your deed this week, not next month, this week. Find out exactly how your home is titled: joint tenancy, tenancy by the entirety, trust ownership, community property. If those terms sound unfamiliar, that's okay. The goal isn't becoming a tax expert. The goal is understanding what you actually own and how it's structured. Most people discover this information for the first time during a family emergency. That's the worst possible moment to learn it. Second, start building a basis file. This may be the simplest money-saving task in retirement. Create a folder, physical or digital. Store every major improvement receipt, roof replacements, HVAC systems, kitchen renovations, bathroom remodels, window installations, solar panels, major landscaping, anything that adds long-term value to the property. Because one day those records may directly reduce your taxable gain. A missing receipt today can become a larger tax bill tomorrow. Third, if your spouse passed away within the last 2 years and you're considering selling your home, talk to a qualified tax professional immediately. Not eventually. Not when you're ready. Immediately. The 2-year window under Section 121 does not stop because life is busy. It does not pause because you're grieving. It does not extend because nobody informed you. The clock runs whether you know it's there or not. And once it expires, the opportunity may be gone. Fourth, if your home has appreciated significantly over the years, schedule a conversation with an estate planning attorney. Not because something is wrong, because something is valuable. Those are very different situations. People insure valuable assets. They protect valuable assets. They plan around valuable assets. And for many retirees, the family home has quietly become the largest asset they own. Treat it accordingly. I want to leave you with one final thought. The families that suffer the largest tax surprises are rarely reckless. They're rarely irresponsible. They're rarely uninformed. Most of them simply learned important information a little too late. A deadline they didn't know existed. A rule nobody explained. A planning opportunity that disappeared before they discovered it. That's what makes these situations so frustrating. The money was never supposed to be lost. The opportunity was always there. The family just didn't know where to look. The so-called widow tax isn't really about taxes. It's about timing. It's about knowing that a 2-year window exists. It's about understanding how basis works. It's about recognizing that the way a home is titled today may determine what happens years from now. And it's about making sure that the wealth you spent decades building actually reaches the people you intended to benefit from it. Because after 30 years of mortgage payments, renovations, maintenance, sacrifices, and hard work, your family deserves more than an avoidable surprise from the tax code. I'm Chase Longwell. If this video helped you understand something you hadn't heard before, send it to one person who owns their home free and clear, especially someone who's recently lost a spouse or may face these decisions in the future. One conversation today could save someone tens of thousands of dollars years from now. And those are the conversations that matter most. Thank you for watching. I'll see you in the next video.